Hello everyone, my name is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and trading algorithms like you see here with our SPY and ES system since 2003 for individual traders, mom and pops, and professional institutions, some of which I consult with on a weekly basis. Okay, we got a lot to cover this weekend, so let's get started. Before I get into the market newsletter, real quick, again, if you haven't subscribed, consider subscribing to our website, Breakpoint Trades, or subscribe to our YouTube channel. You could also sign up for our free list if you're not ready to pay. I send out free newsletters, usually about once a week or every couple weeks. So let's get started. First off, this is our back end for our website where I record our newsletters. This is our audio recorder. I'm going to click record. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. I hope everyone had a very nice weekend. This is a very comprehensive weekend newsletter. We're going to cover everything: the general market indexes, various indicators, it's like I spelled indicators wrong, sectors, bonds, 10-year treasury yield, and commodities. And this is for Sunday, March 27th, 2022. This is the table of contents divided into 5 major sections. There's a lot of charts here, probably going to take anywhere from 45 minutes to an hour to cover everything. I'm recording both a audio newsletter and a video newsletter. If you're watching this in YouTube video format, please at least adjust your resolution to 1080p resolution to get the best effect. Otherwise, you might not be able to read the text. And I'm actually recording this at 1440p. So 2560 by 1440. So that's the actual resolution. Okay. Video format is good so I can point out things, and the standard newsletter form is good because you can read the text, and you can also get our live chart URLs that we share from stock charts, something which I don't think any other service does. So anyway, got a lot to cover here. You can see my table of contents here. I'm going to briefly read over some of this, but again, I suggest you pause the newsletter and read it on your own, look at the website, etc. So as you know, markets had a big rally the last couple weeks. A couple weeks ago, we thought the bottom was coming in around the FOMC. At that time, just before the FOMC 2 weeks ago, we were looking for the S&P to maybe have one more flush to the downside, but it became pretty obvious when it was approaching the FOMC and, of course, on that FOMC day that it wasn't going to happen. Part of the reason for that is that you had a lot of these, and I discussed that here, these options. There was a huge amount of put options in the market that were out of the money. That was helping to support the market. It was hedged, and then you had the FOMC come out, and technically the indexes did. The S&P formed a truncated fifth wave low, and the triple Qs did form a fifth wave low. So they did complete their fifth wave leading diagonal patterns technically, but that's part of the reason, otherwise, these options, why we didn't have that big flush out a couple weeks ago. And the fact that those options were covered, that was bullish on the market, helped fuel this rally. As you know, bear market rallies tend to be quite strong, and that's what we've had. And now in the short term, a negative for the market is that it's not hedged like it was back then, a few weeks back. It's now more susceptible to a sharp sell-off should the market start to pull back here and lose some major levels. Again, short term, what I'm watching for, guys, we have had a big rally up. The S&P is just above its 200-day moving average. The triple Qs are not. The IWM is still below the 209 area. It's been lagging. But on the S&P, the 61.8 fib retracement from the January highs to the lows is 45.50. So that would be a target to the upside. Or should we get a little more upside, I would target that 4,600 area. I can count 5 waves now to the upside, and along with some MACD divergence on intraday time frames, 60-minute, 30-minute, 15-minute. And so short term, I think we're going to soon get a pullback. And as I've been saying, there's both a bull and bear case on the market. A lot of Elliott waivers out there consider this pullback in the market as a large fourth wave, and we're going to make new highs in a fifth wave new high. We're not in that camp still, but that's what a lot of the Elliott waivers are saying. It really doesn't matter because all the counts, the bullish counts, the bearish counts, they've all been saying the same thing short term. A couple weeks ago, both the bull and bear counts suggested a rally, which we've gotten, and now both the bull and bear counts are suggesting a short-term pullback soon. For the bull case, it would be a wave 2. For the bear case, it would be a wave B, and then we should get another rally up regardless. So that all the counts are aligned right now for, in the short term, a pullback coming fairly soon. Short term, this 45.50, this is the big area I'll be watching. Actually, I'm sorry, 44.55. 45.50 is the 61.8 fib. 44.55 is the last higher low. If that's breached, I think that'll confirm a nice pullback coming in the market. Again, either a sharp wave B correction, which could be quite sharp, or a more bullish wave 2. We lean to the wave B. That's what we view. All right. Otherwise, a couple other things. We've had a sharp move up in the 10-year Treasury yield. 10-year Treasury yield is now 2.5%. 30-year mortgages have risen from about 3% in December all the way to almost 5%. That's one hell of a sharp increase in a short time. So it's going to start having a big negative impact on the housing market. Commodities remain in a bull market, as you know. They've been choppy as of late. I wouldn't mind seeing more of a consolidation in that area. But long term, they're in bull markets. The pot marijuana group had a nice move last week. Tilray, MOSS, MJ, that's a couple of the ETFs. That's an area now to monitor as well going forward. But as far as the market, long term, my issue with the market is it's got a lot of things going against it. Markets tend to climb wall of worry, but right now we're in a tightening. The Fed's in a tightening scenario to combat inflation. That's something we haven't had for many years now. We have a coming, most likely imminent economic recession, and we have high inflation. There's a huge backdrop that I think the market's going to struggle with, trying to easily go back to new highs. So anyway, enough said about all this. Let's go ahead and move on. Start looking at the charts. Item number 2 shows the index sector table, what transpired last week and on Friday. You can see for the week, all the major indexes were up nicely, except for the Russell, which was down 0.36%. All the major indexes were up strongly. The Dow was up, otherwise the least, up 0.3%. S&P up about 1.8%. Nasdaq area up about 2% to a little over 2%. As far as the major market sectors, most of these 20 sectors were up. Home builders got hit the most, down 6.8%. Again, those rising 10-year Treasury yields, rising 30-year interest rates, not surprising. That area is going to be in trouble long term. You can't have housing going up so much faster than wage increases. We have another bubble there. What's helped the housing is supply has been very tight, but eventually, guys, that area is going to come down. Been looking to sell some investment properties I have. Biotech, healthcare down a little bit, retail down. Some big moves otherwise. Energy, you could see up anywhere from 9 to almost 7.5%. Other sectors were up decently as well. Currencies, US dollar up 0.6%. Cryptocurrencies had a nice week. Again, continue to keep your eye on cryptos because they've been leading and they continue to hold up. So that's a short-term positive. So keep an eye on those. They've all moved nicely out of their wedge patterns, at least Ethereum has. Commodities, all big moves here, except for copper. And I kind of wonder if copper is lagging a bit because it is an industrial type metal. If we are seeing some economic slowdown, maybe less copper utilization. But obviously, a lot of the moves in the energy area, agriculture, that's affected by the Russia-Ukraine issue. But, those have all been bull markets anyway. But all these commodities up strongly. You can see crude oil up 10.5%. Precious metals were up as well, gold and silver. And GDX, the miners, up 4% for the week. Big moves in these bonds, like I said. Look at that move in the 10-year Treasury yield. Okay. So again, market's got a lot of headwinds here, from the rising long-term rates to inflation to slowing economy. The Fed is boxed in, guys. Next, item number 3 shows the economic news calendar. Next week, being the first week of the month, we have the non-farm job payroll report on Friday. That's a big one. And of course, any of this economic news here. And they're going to be starting earnings season here soon. So let's go ahead and dive right into the charts here. First chart below, item number 4 is a yearly snapshot of the major indexes. Okay, so they're obviously well off the lows here, but they're still down for the year. Dow's down 4.1%. It's down the least. S&P down 4.7%. Nasdaq 9 and Nasdaq 100 down about 9.5%. So they've had a good rally, but they're still down quite a bit. Small caps down 7.2%. And DBC, that's the commodity ETF, up almost 31%. So look at those two big moves back to back. All right, back to back years. Commodities have been in a bull market for 2 years now. Next. Chart number 5, here's a monthly view of the major indexes. I talked about this a couple weeks ago. The middle Bollinger Bands on the Dow and S&P would likely offer some support short term, and they have. That's essentially where we rallied off of. Now we're going to form lower highs here. We'll see. Of course, the Nasdaq area, they went well below those. They're back above the middle Bollinger Bands, but they dipped below it. And the Russell, you can see at the bottom here, there's a resistance right here it's dealing with. Next. Chart number 6, this shows you the quarterly view of the indexes. And again, you can see well off the lows so far for this quarter. But you can see my comments back in November last year. These markets tend to end with blow-off tops. The slope here was unsustainable. Would likely need at least a rest. And so far, we got a rest for 1 quarter. Now, the quarterly is interesting here, guys, because at the end of the first quarter, if the Dow is up, that tends to bode well for the year. But I think that's unlikely now because it would have to, rally, nearly 4% this week to go back positive. But I'll keep you updated if that obviously occurs. Next. Moving on to the indexes, individual indexes themselves. Let's just go ahead and cover the Dow here quickly. We don't cover the Dow too much. It's only 30 components, but you can see it's rallied up the last couple weeks. So far, we got a lower high here in place. Remember, we had a Symmetry break back here, lower high. We had a divergent high back here. MACD, RSI. Now, the 60 stochastics, I always tell you guys to monitor this 50% area. You can see so far it's bounced off the 50%. That doesn't mean later on it might go through it. If we're in a bear market, it will. But this 50% is always an important guide to watch. Remember, that's on the 60 length stochastic. Okay, so we'll see if it forms a lower high here over time. Next, chart number 8. Here's the daily view. Again, it's come quite far, quite fast. Sort of a symmetry move with respect to this. A little bit larger, in fact. And there's a little resistance area right up in here. Supply zone, 200-day moving average. So logical up in here soon would be in logical area for some sort of pullback soon. Now let's go ahead and move on to the S&P 500 charts, which are our proxy. Chart number 9, here's the monthly view of the S&P. This contains this big, the monthly chart here with this moving average ribbon that we like to reference. We've been talking about this since last year, last fall. And even back last in November, December, we talked about how wide the moving average ribbon is. Again, it's a very simplistic thing to look at, guys. Common sense, moving average ribbons, they get too wide. They need to go through a period of contraction. They go through expansion and contraction. It's these contractions which end up being decent buy opportunities. This one lasted almost a year, back in 2015 to 2016. Back in 2020, you had a little contraction here. But we've talked about this, how wide this sucker is. It's going to take a long time for this to go through a contraction phase. It doesn't mean you can't make a minor new high here if this ends up being a 4th wave or something, but for this to go through a contraction similar to like it was back in here, this could take 1 or 2 years perhaps. That's our concern longer term. Otherwise, you can see we bounced around the middle Bollinger Band here. Next. Chart number 10, here's another monthly chart of the S&P that we've been shown. Shows you back to the beginning of that bull market in early 2009, March 2009. This was that bear market in 2008, of course. And it shows this nice clean uptrend channel. The view we've been looking at is where you'd have an end of the bull market, essentially back there in late December, early January. And we're now going to work lower eventually in some sort of bear market that could last 1 or 2 years, perhaps. Bear markets tend to be retracements of previous bull markets. Here's some fibs as guides. Now, longer term, we haven't seen some of the traditional things trigger. Usually in the past bear markets, what you've seen is this 14-month stochastic fall below 50%. And you can see it's nowhere close. Absolutely nowhere close. Back here in late 2007, early 2008, it fell below there. Okay. And the 60 stochastic is still firmly above 80%. Now, this would tend to support more the bullish case, major wave 4 pullback. So that's potentially one for the bulls if you want to consider that. Okay. We'll see which one plays out, guys. But because of that, I do leave both options on the table. But now let's go ahead and show you the bullish case that most of the Elliott waivers favor. Chart 11, here's the count that most of the Elliott Wave guys favor from what Steve told me. So shows you the same channel, but instead of having wave 5 here, wave 5 would be out here. Okay, so with this large correction from January till late February is a wave 4. And we're going to go up to new all-time highs in a wave 5. Again, perfectly valid count. The reason why I think this could struggle is because of some of the backdrop. The Fed's on 7 rate tightening cycles now. There's high inflation, a likely recession coming with the yield curve. But who knows? Maybe we get that blow off top. But even if we do, it really doesn't matter. Like I said, short term, both the bull and bear counts are all lining up anywhere. They called for a rally a couple weeks ago. They're calling for a pullback in the short term soon. But if we did get an eventual rally to new highs, it likely wouldn't go that far. It'd end up here somewhere, maybe 5,000, a little over 5,000, something like that. Then you start your bear market afterwards. So what I'm saying is if we get this fifth wave, I don't think you start some multi-year bull market again. All right. Next. Chart 12, here's the weekly chart Steve showed last week, and I'll just keep it in here. So this shows this channel, which we broke. We had a leading diagonal. We broke to the upside. We're now rallied up to the middle portion of the channel, resistance. So ultimately, we favor some sort of lower high, maybe in late April, maybe even late May. We'll see how long it takes. But then ultimately form some lower high. These leading diagonals, by the way, can retrace quite a bit. They can retrace well over 61.8%. Suck all the bulls in, get up into this area, and then start its bear market downtrend. We'll see. See which one plays out. Next. Chart 13, here's the weekly view of the S&P with the moving average ribbon and stuff. Again, we've had a nice correction this year. Nice up week the last 2 weeks. And, we'll see where this goes. Ultimately, if this does form a lower high or in the next couple months, this would be a symmetry target area down in this range. Next. Chart 14, here's the daily chart. Again, this was this leading diagonal we were showing. And a few weeks ago, we were looking for maybe one more flush down to here. But we didn't get it. We had a little double bottom right here. With all the sheer number of puts in the contango, that helped support the market. Then you had the FOMC on this day, and it became pretty obvious we weren't going to get that washout. So we favored an upside rally from there, and that's what we've gotten, and it's been pretty sharp. It's retraced just under 61.8% of the move from the January highs to the February lows. So right up in here, logical area for a pullback. What I favor now, though, guys, is when we get a pullback, though, not to come all the way back down, though, but instead to go ahead and draw this out for you. It could be like something like this, and then up, and then down. Okay, so this would allow it to still work its way through April, maybe into May sometime. So that's kind of what I'm favoring, guys. But again, doesn't mean I'm right. That's what we're monitoring right now for a roadmap. Okay. So right up in here, also the 4,600 area would be a resistance. Just as an educational standpoint, all our charts have these moving average ribbons. You can see how good a guide these are. When they get too wide, every time they got too wide here, end up being market reversals off those lows. So use these moving average ribbons, guys. They're very useful. Next. Chart number 15, here's that leading diagonal Steve talked about a week ago where, again, we did technically get a fifth wave move down to complete that leading diagonal. It shows up on the line chart really well. Next. Chart number 16, here's the KISS system. So actually the KISS shows a new long here as of Friday with the DVT stop way down here. My issue with this though, guys, is that, you know, in this volatility, that's just too wide. I would have preferred to go long back here after that FOMC day when we thought the market was going to rally. You know, up in here, it's more likely some sort of whipsaw would be my thing, or wait for some decent pullback before buying, because remember this KISS daily trend system, it's good for trending markets, but when you get this real volatility like this, you can get some whipsaws. I've been showing a 30-minute chart, which I forgot to put in here, but it's done a really good job about catching this uptrend. Next. Moving on to the intraday charts, chart number 17. Here's a 2-hour view. So again, you can see this leading diagonal, a little double bottom there. We've had a sharp move up here. On this last move here, we do have some RSI divergence and MACD divergence finally. This is your 61.8 fib retracement right here at around this 45.50 area. So right here where we're at. And if we get through there though, this 4,600 could be a target. Notice your moving average ribbon's getting a bit wide up there now. Next. Chart number 18, here's a 60-minute chart. This breaks it down into some of these wave counts. Like I stated, you can count 5 clean waves to the upside, and you know, doesn't mean it's over. It could still push higher. That 61 fib, maybe this 4,600-ish area up in here, 45.90 to 4,600. By the way, if we start getting a sell-off below this 45.55, would likely start that move to the downside. Okay, it would trigger that because that's the last higher low. And because we don't have all these put options protecting or hedging the market, it could lead to a sharp pullback. Notice we have some nice MACD divergence building here. So take note, guys. Next. Chart number 19, here's another 60-minute chart showing you the same thing. Again, if you go back to my newsletter on that FOMC day, I talk about going long the S&P with a stop right there at an intraday low. That would have been a great area to go long. Okay, stop would be right here from a swing trade basis, 45.55. That's an important level. Okay, you can see a potential wedge-like pattern forming. Next. Chart number 20, here's a 30-minute view. Shows you the same thing. Next. Chart number 21, here's a 15-minute chart. We had a little coil starting to break late in the day. We'll see where we open on Monday. Moving average ribbon, this is a good guide to monitor come Monday, Tuesday if this goes negative. These areas here, horizontal lines, they're your next major support areas. Finally, chart number 22, here's a 15-minute chart with a wave count. You can see this little ending diagonal starting to form here. Again, wave 5 could extend here. Sometimes this wedge is not very steep. Sometimes I see these will break up out of the wedge first. So, like I said, the 4,600 area could be a target if we get a sharp move to the upside out of here. Next. Chart number 23, here's the various cycles to the S&P from my KISS charts. So we broke above the ATR. That's one reason the daily KISS went long. We have some amateur buying up here. It tends to be early, but take note of that. These bottoms lately have been on the mark 9s. The positive is the moving average ribbon did flip positive a good week ago. You can see on the half day, The ATR is your support. We rallied from it here, but it's support now. It's support on all these lower time frames. In the 60-minute, we have a little end of bull cycle here to take notice of. Next. Chart number 24, here's the triple Qs, monthly chart. Again, nice pullback the last 2 months. We're up this month. Take notice of the stochastic down here. This 50% area on the 14 stochastic has been major support. You can see we're nearing that, so an area where it could find some support. And the 60 stochastic, this 80 area, it's been staying above 80 for all these years. Look at this. During the last bull market. So we're now once again right here where we could bounce off of it. Next. Chart number 25, there's the weekly chart. We bounced right around the 38% fib from the retracement from the 2020 lows to the January highs. Oh, looking at that monthly chart again, guys. So one for the bulls, you know, if those stochastic do hold those areas, you know, that's one for the bulls. Next. Chart number 26, here's the daily chart. You know, we had that leading diagonal, just like on the S&P. It did make a new low, though, fifth wave. Now, these rallies have been larger than the previous rally that was in January, so this is a symmetry break. So this would lead to a higher low. That is why, again, just like I showed you on the S&P, you know, why we favor when we get some sort of pullback for it to form some sort of lower high. I mean, higher low, and then another up move because of these symmetry breaks. Again, you have the same thing on the S&P as well. Let me clear this out. All right. The Qs, they're still below their 200-day moving average. Next. Chart number 27, here's the 2-hour time frame. We had a perfect little double bottom rally. We had a power gap here. These gaps over downtrend line, that's bullish. You can see your moving average ribbons. Every time they got too wide, these ended up being bottoms. Trade bottoms, just like this last time. Okay. Next. Chart number 28, here's the 30-minute chart. You can see this leading diagonal or any diagonal starting to form. And on the 60-minute 2-hour chart above, you do have some MACD divergence. Next. Chart number 29, here's the triple Qs daily. So this went back long early last week. DVT is pretty wide. Stochastic here. It's the 60 stochastic right underneath this 50%. That tends to be an inflection area. Next. Chart number 30, here's the various cycles. So very similar to the S&P. We have all these A's in the daily. We're above the ATR. You have some A's, the Mark 13 on the half day. ATR in these lower time frames are support. You have an end of bull cycle in the 60-minute. Next. Chart number 31, IWM Russell 2000 weekly chart. It was actually down for the week. Remember, it topped out first last year. This will be something to monitor going forward. This big area is now resistance. If we are in some sort of bear market, over time we will test this area likely. This is resistance now. Next. Chart number 32, here's the daily. The daily's been lagging. You can see this is resistance. All right, this downtrend line is support. Next. Chart number 33, here's the daily kiss. This went long way back here as a washout. We ignore if there's only 2 DVTs, so technically this is still long. I wouldn't keep a stop down here at this point. I'd probably at least move it up into this range. And so far, this hasn't been able to confirm over its ATR yet, as you can see. Finally, chart number 34, IWM in the 2-hour chart. We had this double bottom back here, and it's been in this horizontal rectangle range. Moving average ribbons, they were too wide. These were bottoms, trade lows, and it's to a bullish configuration. So there you go on the indexes, guys. Let's move on. Look at a couple FANG stocks. Look at chart number 35, Apple or Crapple. Had this falling wedge, fifth wave move. It was a good low risk, long opportunity down here off this doji and recapture the 200-day moving average. So super move up. Boy, it's not very far from the highs, is it? In fact, this move is larger than this move, so a symmetry break. But it's up 9 days in a row. It's due for some sort of consolidation now. Next. Chart 36, Amazon. They also is at a nice move back to its 200-day moving average. You can see the moving average ribbons. They got too wide back here. Those are your trade lows. Along with your divergence, you had a nice low risk trade setups down here for longs. Now you have had a symmetry break here, so just like on the market, I favor a higher low on the next pullback. Next, let's move into Bitcoin, since this Bitcoin has been sort of correlated with the market. Here's Bitcoin. It's trying to eke its way out of this pattern, hasn't fully yet, but it's holding up. Next, chart 38, Ethereum had this wedge-like pattern, which broke out about 2 weeks ago, and it's been meandering higher. This shows you a possible symmetry move. So the cryptos are holding up, guys. Let's move on to some indicators. Chart 39, here's the VIX. So the VIX went on a buy signal back here a couple weeks ago when it fell below the upper Bollinger Bands. Right here, that ended up being a trade low. And then last week it went back inside its lower Bollinger Bands. But, you know, we only had a one-day pullback right here, and the VIX keeps working its way down. It's now below 21. Next. Chart 40, here's the VVIX. This is one we're keeping a very close eye on. It's now at, what is this? 109.21. Remember, this gave a sell signal on the market way back here in early January when it went above 110. When it's below 110, it goes above 110. That gives you your sell signal. So it's kind of locked and loaded here. When it goes above 110, this might be a good sell signal. Next. Chart 41, here's the S&P with a bunch of these indicators. Here's the VVIX right here. So it's in a histogram form when it goes above 110. It's a nice way to view it. Here's the VIX, the Bollinger Bands, and some of these other indicators like the put call, NYMO, NYHL. You can see when the NYHL dipped below its lower Bollinger Bands here, those end up being trade lows. So this is a nice chart with a collection of these indicators that you can use. Again, if you're a member of ours, you could get this chart, live chart, and follow it on your own instead of this static chart. Next. Chart 42, put call ratio. I meant to remove this, but I'll go ahead and discuss it. So I talked about this a couple weeks ago, that the fact that market was going to new lows or was declining, but this was made a lower high. That usually occurs when markets have their second corrections. And also, that was indicative that there was a lot of market was already saturated with a lot of puts. And that's one reason the market didn't decline here again. So that was actually a bullish on the market a couple weeks back. Next. Chart 43, here's the Nasdaq with the new highs, new lows, and the 52-week highs minus the lows. And this is an inflection point, guys. I talked about this way back in November and early December. The fact that when the 52-week highs minus the lows, when it went negative, I said that was very bearish. And unless it recaptured, went above zero and stayed, that we could be in a bear market. And it stayed. In fact, every time it's gotten close to zero, those were inflection points. Right here, early December, was a high. Here in early January, a high. Here in early February was a high. Here in late February was a high. See that? And now we're right back near this zero area. So is this yet another area where we're going to get an inflection point down? We'll see. The wave counts tend to support that. Next, chart 44. Here's the same chart for the S&P, the new highs, lows, and the difference. Now this one tends to be much more reactive than the Nasdaq. You can see it actually went positive way back here on the 14th, right at the one move off the low, and was confirmed here. So if you want a faster one that reacts a little bit quicker, this is a pretty decent one. But longer term, I like that Nasdaq just for the bigger views. But shorter term, this one tends to be pretty good. What I like to look at for is confirming candles, though. Next. Chart 45, high yield corporate. As you know, they've had a big decline, and they're starting to move down here. They've been leading the market, so this could be foretelling that the market may soon want to pull back. But I am looking for a higher low just because it did have a symmetry break here. Next. Chart 46, here's the yield curve. That's the 10-year divided by the 2-year. It hasn't went inverted yet. Down here is inverted, below 1, at 1.08. So the ratio is very close. Like I said, an inversion here is imminent, and it's when it goes inverted, you basically always have a future recession. So an economic recession is coming in the future, guys. You know, the Fed's tightening. We have all this inflation. Pretty obvious. Next. Chart 47, TLT, weekly chart. Big loss, big down week, down 3.6%. Lost this big support. Shelf support. Actually, the long-term shelf support's not down here till about 120. If the 10-year treasury yield were to move like that, boy, maybe it'll go up to 3%. Next. Chart 48, here's the daily view of TLT. Moving to new lows. Next. Chart 49, 10-year treasury yield, weekly view up 16%. We had a symmetry target here of 24, but you know, it's now at 25. Remember, divide this by 10, so 2.5%. Next. Chart 50, there's the daily. Again, just up and away. Moving average ribbon was pinched back here in this consolidation. It is getting a bit wide here, so maybe it'll pull back soon. But long term, it is strongly up. Next. Let's look at the big pictures. Here's a 10-year treasury yield back to the 1970s. So the rates, as you know, peaked back in the early 80s. You could draw a multi-year, 30-plus year downtrend line. And we're coming up near this. Breaking this could start a secular bull market on long-term rates. Consider that. Remember, they've been in a secular bear market for 40 years. Next. Chart 52, here's the same chart, but as a log. This is really the better way to view it because you can connect 4 data points, including the highs. So it really needs to get over this downtrend line, but, say over about 2.7, 2.8% would do it. Quite a move up off those lows, isn't it? Again, consider that, guys. This would break the secular bear market in interest rates and start a secular uptrend in rates. All right, let's move on. Chart 53, XHB, that's the home builders. The home builders have been suffering, as you'd imagine. The 30-year mortgage is something like 4.75 to 5% now. It was only 3% in January, guys. So that's really hurting the housing market, as you'd expect. Little symmetry move here. Recently stalled at the 50-day moving average. Looks bearish again. We had a symmetry break back here. This is a good short way back here on that symmetry break, lower high. Next. Chart 54, DBA or DBC. Actually, let's cover this below. It's a little duplicate chart here, so let's go ahead and move on. Let's go ahead and move to the market sectors. We're going to look at most of the important sectors. So here's XLE Energy. As you know, this broke this downtrend line back in the first part of January. It's in a nice bull market trend, guys. Energy has been one of the leading sectors this year. Had a nice pullback the previous week, but was a buying opportunity yet again. Up 7.6%. Next. Chart 56, there's the daily chart. Again, all these pullbacks so far this year have been buying opportunities. I'm kind of wondering if this is going to make a strong new high or if it's going to consolidate. I would love to see this consolidate because I know a lot of folks are looking to buy back into these areas who took some profits. Next. Chart 57, oil services, same deal, big move up. Big move up this year, obviously. Remember, guys, these are in secular uptrends. Next. Chart 58, oil services on the multi-year view. Again, OIH, oil services, was basically $1,000 here in 2014. It's still only 300, guys. If you bought this and just didn't look at it, you would probably be fine in a couple of years. This could have a long way to go over time. Next. Chart 59, XME, metals and mining. I highlighted this as a low-risk buy opportunity a couple weeks ago at the 20-day moving average. If you put a buy limit there for a buy, you get an awesome move. It's now made new highs. Up, up, and away. Next. Charber 60 utilities also made a new high here. Not surprising with these bonds and rates. Next. Charber 61 banks have rallied up, but they're struggling. Remember, banks and financials, they do better when the yield curve is wider and it's tightening. So despite interest rates going up, it's not helping them, guys. Next. Charber 62 financials, they've had basically a symmetry move. They've fared better than the banks. So far, basically a symmetry move respect to this last rally. Next. Charber 63 biotech, we pointed out this falling wedge a couple weeks back, and it did give a trade. So far, it's kind of consolidating here. Is it going to have yet another move here to meet symmetry, or is it going to pull back? If it pulls back, I'd like to see it hold this wedge. But it did give a trade out of this wedge. Next. Charber 64 semiconductors, nice move as well. Slight symmetry break. Perhaps this rally here. Actually, if you count the high here, it hasn't broken, but it's well above its 50-day moving average now. Next, Charber 65 transports. They've had a big move recently. This is a big resistance zone right up in here now. Next, Charber 66 materials. Boy, this has had a huge move. Look at this. Blew through that 61 fib. You can see the moving average ribbons in a big expansion. Next, Charber 67 industrials. Nice move after filling this support zone here in February. Nicely above the 200-day moving average now. Next, Charber 68 consumer staples. Back to this downtrend line. Could be a big coil if it pulls back from here. Next, Charber 69 healthcare. Next, Charber 70 consumer discretionary. You can see these symmetry moves on a decline. We do have a little symmetry break here. So maybe a higher low forms now on a pullback. Next. Charber 71 retail was in a strong downtrend, broke that trend line a couple weeks ago. It's now consolidating here a bit. Next. Charber 72 emerging markets. They've had a nice rally here as well with the markets. Dotted lines here represent your symmetry. So far, we haven't broken symmetry, so this rally hasn't exceeded these yet. So keep an eye on that. Next, an area to monitor are some of these pot stocks. Now, sometimes these start to rally when the market's near a high. Be aware of that, guys. But Tilray, a lot of these pot stocks had big moves last Thursday and Friday. Next, Charber 74, MJ, one of the ETFs. Perfect double bottom here, multi-year bottom. You can see the MACD is curling up. We've had 2 up weeks, but it looks pretty good here, quite honestly, especially if you get a little pullback that's on lighter volume. Next, Charber 75, here's the daily. You got a nice long downtrend line here. Strong volume break, multi-divergence on the MACD. Looks decent. Next, Charber 76, MSOS, another ETF. US-based. Notice you could draw a downtrend line from the early 2021 highs. We haven't broken that. This one's lagging a bit, but this is one I own a little bit of in case it starts to play some catch-up. All right, let's move on to commodities. Charber 77, here's the CRB S&P ratio. You know, I've shown this for a while that, you know, this ratio suggests long-term the commodities are in a bull market. They're going to outperform the general market. They pulled back the last week, but 2 weeks ago, but the ratio was up this week. But you can see it's expanding out of this long base. This also suggests a longer term, maybe bear market cycle in the general market, secular bull market in the commodities. Next, Charber 78 DBC commodity ETF. We talked about this little blow off top. We did get a 2-week pullback, but we're back again. Can we make another high here? Are we going to just chop around here is the question. Next, Charber 79, here's the monthly view. Again, strong move off that 2020 low. Commodities are in this secular bull market uptrend, as you can see on the monthly. Next, Charber 80, daily. Sharp move down here. They got a little parabolic. You can see your moving average ribbon got too wide, but nice recovery. Again, can it eat? I'm not sure if this can easily make a new high here, or maybe it needs to chop around. Maybe coil, something like that, I would prefer. Next. Chart 81, crude oil. Nice rally off this 50-day moving average. Stalled near the 61 fib, which what you'd expect. Now we'll see if it needs to consolidate, chop around a bit. Next. Chart 82, there's the monthly long-term view. Again, this is in a long-term uptrend. Resistance here, which we briefly went above. We went to 130. But I think longer term, most of you'd agree with me, we're going to probably take this out over time. The 2008 highs. Next. Chart 83, natural gas. We pointed out this coil, which started breaking out last week. Next. Chart 84, copper. One of the commodities that is not really running. I mean, it is obviously had a big move up from the 2020 low, but it's been stalling here lately. I'm kind of wondering if the slowing economy is maybe weighing on that. Copper's a big industrial commodity. Next. Chart 85, DBA, agriculture. Been strong uptrend, as you know. Next. Chart 86, there's the monthly view. Again, broke out of this. This is a multi-year chart, guys. Broke out of this in 2020. Strong uptrend. You can see a ribbon went bullish back here, confirming the long-term uptrend. Next. Chart 87, DBA S&P ratio. Same deal. Moving average ribbon is flipped bullish here. Next. Chart 88, Joe, the coffee ETF. Bounced near the 200-day moving average. You have a little symmetry break here with respect to this downtrend line. I'm wondering if you get a little higher low here that forms. Next. Chart 89, uranium ETF. As you know, that's in a long-term bull market as well. One I identified back in late 2020. Coming out of a Stan Weinstein type base. Next. Chart 100, US dollar. Up for the week. Still has kind of a bull flag look. Dollar still looks potentially bullish here. Next. Chart 91, US dollar daily. Here's your resistance to monitor. Next. Moving to precious metals, chart 92, gold. Up about 1.3% for the week. You know, we had that little blow off here, logically stalling at the 2020 highs. I do believe we'll eventually take that out, probably this year. You could see how everything was set up here weeks ago out of the tight moving average ribbons, the coil on the ratio, etc. Next. Chart 93, gold on the daily with the moving average ribbons. Again, we had a coil back here. We busted out of, got too extended here. Moving averages got too wide. See, when they get too wide, those all led to those previous peaks, just like it did here. This is your big support. We didn't quite make it down to there. Now we'll see, you know, what it does in here. It needs to chop around a bit. Next. Chart 94, here's the gold with the GDX-GLD ratio. We always like to monitor what the stocks are doing. They lead. For now, the stocks are still leading. Next. Chart 95, there's the monthly chart. This shows you a potential longer-term bullish view. I've shown it before. Some possible symmetry targets here, 2315, 2600. You have this kind of large cup and handle look. Again, this is a monthly chart, guys. It's going to take a long time for it to play out. Next. Chart 96, silver. Broke out of this coil a month ago. It's chopping around at this point. You had a double bottom back here. Next. Chart 97, silver on the monthly view. This is your long-term support. Next. Chart 98, GDX. Big rally this year, as you know. They've been leading. You can see it on the ratio. This is a symmetry break, by the way, with respect to these previous rallies. So that confirms next major pullback should form higher lows. Next. Chart 99, GDX on the daily. Nice rally off the 20-day moving average. Again, guys, as I talked about in education, when you've been strongly uptrending above the 9 EMA, when you break the 9 EMA, you almost always rally off the 20, which is what we did. Now, what I wonder here, can we go back to the highs, or do we need, is this some sort of B, then we come down into C, coil, something like that is what I'm wondering. Next. Chart 101. Here's the 2-hour time frame. Possible little wedge there. I didn't throw any individual stocks in here tonight, guys, just because I got enough charts. So, again, that'll do it for this newsletter, and looks like it was 50 minutes. So we'll see how futures open here on Sunday evening, and, of course, how we trade this week. Have a wonderful rest of your Sunday, everyone, and have a good trading week this week. Take care.